In today's video, I'm going to be talking to you about one of my mean reversion trading strategies that I personally use to help even out some of my trading performance. What do I mean by that? Well, many of you guys who have watched my channel have probably seen me trading my momentum style trading, which is of course when things are trending very well, I'm trying to ride those trends and profit from them. But the market doesn't always trend. So instead, you can see on the screen here, I think that there is a magic sort of having a dual strategy or even a triple strategy approach within your trading portfolio. What do I mean by this? Well, there's different market environments. There's markets where the stock market is running hot or it's crashing, or there's times where, various markets are range bound or whatever. Well, in this video, I'm going to show you one of the strategies that I use to help traverse the markets a little bit when things are not trending very, very well, which is in its simplest form, the idea of a mean reversion trading strategy. So when markets are more choppy, when they're more range bound, they're moving back and forth, mean reversion strategies are going to do better, right? When things are getting overextended and they come back, and under too far low and then they come back. Strategies that look to capitalize on those reversions to a moving average or a mean are usually very well performing in those types of environments. And other times when the markets are trending very well, those strategies might struggle. But what you can see here is that in the blue, I have my traditional kind of trend following performance. So what I mean by that is that during certain periods of time when the market is not trending, you may get this kind of subtle, small losing streak. And then occasionally when the market starts to really trend, which is, by the way, not the usual. The market doesn't trend all the time. It only trends, let's say 35% of the time, the market's really moving in one way or the other. Well, so in those scenarios, we can make those nice, steady, huge profits that trend following can deliver. But mean reversion does kind of the opposite. Most of the time, the market is back and forth and indecisive. And so during these periods of time, a mean reversion strategy can make good money. And then occasionally it will give back some of those gains during a really trendy environment. So by having both, you can see the green line here is the combined idea. If you have both of these trading strategies, it's not going to be as smooth as you see it on this screen. This is just an example, but overall, it acts to try and mute some of those those drawdown periods, which can be tremendous in either type of strategy. But by combining both, having a strategy for each, you can sort of normalize the returns a bit. So this strategy that we're going to talk about here today is primarily mean reversion based. It is a strategy that focuses on essentially selling high, buying low, rinse and repeat. And again, there are times where this does very well, and there's times where this does not do as well. So with that out of the way, that is kind of the context behind this trading strategy, this addition to my own trading portfolio that I've used for years now to kind of mediate some of those, mute some of those drawdown periods for my other trading strategy. So first of all, as I mentioned, this is a basic mean reversion style of trading, and it's a very popular style of trading amongst the options trading community. But I'm not buying options, right? A lot of times you'll see on Instagram, social media, right? People who are just long calls on a big tech stock, or they're buying puts because they think a market is going to crash or something like that, right? This strategy is actually not buying options at all. It in fact is the opposite. It is selling options for premium. So if traders out there think Google is going to jump by 6% in a day or something like that, perhaps you're more on the willingness to just sell them the option to do that. Of course, cash secured covered calls, things like that. We'll get into that in just a moment in terms of making sure that you're not exposed to a huge tail end risk. And we'll talk about that, like I said, in just a second. But let's get into this. So of course, if you don't know what a call and a put is, first of all, let's go through those definitions very quickly. So before we can talk about selling calls and selling puts, you should probably know what calls and puts are in case you're new to this stuff. So bear with me if you aren't new. This is just going to be a basic recap. A call option is a financial derivative that gives its owner the right to buy a specified security at a set price within a certain time period. It is the right, essentially, but not the obligation. You don't have to, but you can buy a security at a certain price locked in when you buy the call. So for example, let's just say, and keeping this really, really simple, let's just say that you are looking at Apple, okay? And Apple is trading at $100 per share. And let's just say that you want to buy a call at 110. So what I mean by that is you are basically buying one contract, which, by the way, contracts trade in 100 shares. So essentially you are buying a call option, which gives you the right to buy 100 shares at 110. So obviously, if the price is currently trading at 100, that doesn't give you very much of a good right at all, right? So 110, I don't want to buy them at 110. Why would I want to buy them at 110? Well, it gives you the right, but not the obligation. You don't have to buy them at 110. But if this market rallies, let's just say, to $120 a share, obviously having the right to buy them at 110 is a luxury. You're going to pocket $10 in the difference in price right away. So obviously this would be a very attractive thing if you think Apple is going to go up. So in that case, you would take a $10 gain, times that by, of course, a 100 shares, since you did a contract, which is again 100 shares. You did that times 10, that's $1,000 profit that you just made. And by the way, this call option did not cost you anywhere near what buying the shares would have costed you, right? 100 shares at $100 is $10,000. It wouldn't have cost you nearly that much to buy this option. That's why people love to buy options, because they can create huge gains very quickly. But as much as that sounds attractive, in this video, we're going to be doing nothing of the sort. We aren't looking to buy these options, although there are traders out there who do well doing that. We're actually looking to sell them, and I'll talk about that in just a second. But first, we also need to know what a put option is, so let's do that as well. A contract giving the option buyer the right, but not the obligation, to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. It's basically a call option, but it's the opposite. You're betting something will go down if you're buying puts because you think the price is going to drop. So you want the right, but not the obligation, to sell or short a specified amount of an underlying security at a predetermined price within a specific time frame. It sounds complicated, and it kind of is, but once you get to know this stuff, it really is not too bad. And if you stick around, I'll show you some examples and even some current examples that I'm in of this strategy that we're talking about here in this video. So now let's get on to actually the strategy itself. So behind every person that buys a put or buys a call, there is somebody who sells that call or sells that put to them. Why would you want to sell someone the right to sell or buy something at a predetermined price? Well, what the option seller gets out of it is the premium. By selling an option, you're taking on somebody else's risk. Because imagine if you sell a put and the market drops and suddenly you have to buy shares at a higher price, that could cost you a lot of money. Essentially, you're taking on, somebody else wants to buy that put, you're selling them that put, which is essentially selling them insurance on their trade. So first, let's get back to the options in just a second. Let's talk about step number one within this trading strategy. We want to identify a relatively steady asset, stock, or ETF that I actually like fundamentally. So I want to own this thing. I don't mind having it in my portfolio. I'd be happy to own the shares of whatever this is. It must be something that I am comfortable owning, not only for now, but longer term. It needs to be something that, again, I do not mind owning and that I would like to buy on a discount or a sell-off. So step number two is going to be waiting for an oversold reading on the daily or weekly chart. So going back to our simple technical analysis, we're just looking for this market to become overextended to the downside. I'll show you a quick example. So we're looking here at GDX, and this is a gold miners ETF. So these are companies, of course, that are mining metals out of the earth. And just as a simple technical indicator, I've got the A1 extension zone. This is a tool available on our website. I'll also leave a link down below in the description. All this tool helps us to do is to spot overextended levels using standard deviations, moving averages, and Bollinger Bands. It's a really simple indicator that we've built for TradingView.com. So when markets become stretched and they move further into the red or green zone, I use this as a simple indicator to indicate that, hey, price may be becoming a bit overextended. And while it is not a perfect indicator by any means, it generally helps to spot opportunities that could be coming in the market when things are getting a bit overdone one way or the other. So I'm looking for, again, a scenario in which case the extension zones are getting breached. You're getting basically price getting significantly oversold or overbought. So once we've found an oversold reading on the daily chart or weekly chart, which is where I personally will trade this sort of strategy, this is where things start to get interesting. I am going to start looking to sell a put on that security. So if I really like it, I like the story and I don't mind owning it, that's where we get to step number 3, which involves selling an out of the money cash secured put. What is a cash secured put? Well, remember, if we're selling puts on something, we are saying, hey, if this, in fact, I'll go back and show you an example. So we're looking at GDX. And let's just say that I sell a cash secured put around this level. And let's just say the market drops substantially, right? I still buy the shares at this predetermined level according to my option that I've sold. So of course, if this market drops a lot, I'm going to be in a drawdown right off the bat. This is why I said this is something you need to be, kind of confident in, something that you actually like and don't mind owning for the longer term, because this can and probably will happen to you if you use this strategy. It's not perfect and no strategy is. And if this is sounding confusing, don't worry. I will show you some tangible examples and some simple, ways to understand this in just a moment. So I'm selling an out of the money cash secured put, and this is basically saying I'm selling this put and hence will collect a premium for essentially offering insurance to other traders, right? So I'm collecting a premium just for selling somebody else this option. What does that mean? Well, the options buyer pays an extra premium for the right to buy a put or buy a call, right? So they buy this call or put, this option, there's a premium they pay, and that is essentially like insurance businesses, where insurance, of course, they collect premium from everybody all the time, and then every once in a while they have to pay out somebody's large expense fee, but the overall profit is moving up and to the right with the occasional sharp pullback. So the idea here with options selling, it is a similar kind of idea. If now we get to number 4, so if the security trades above the strike price by expiration date, I pocket the full premium and I go back to steps 1 and 3. So let's go back to our chart here for just a second. So let's just say that again, we sell a put, let's just say it's 24, and the market pushes back up. Then I just collect the full premium and I don't have to do anything else, right? I don't have to buy the shares. I don't have to do anything because at that point, the option expires worthless, which is what I want. I sold the put, I'm short the option basically. I want the option to expire worthless. Things start getting more fun at step number 5. If the security trades below the strike price by expiration date, I'm obligated to buy the shares at the agreed upon strike price. So let's just say I sell $45 puts on this, undisclosed random ticker. 1 week until expiration date, let's just say it's a short-term option that I'm selling. And I believe, I'll buy the shares if it keeps going down, but I'd like to obviously make money if it doesn't. So if at this point, this red dotted vertical line, let's just say that's when I was looking at this, I sold a put at 45. So if the market comes down and below my strike price at expiration date, I need to buy the shares. Even though the price is below where I agreed the strike price, I still have to buy at $45 per share. So let's say it's trading at 40 at the time of expiration day, but I still have to buy it at 45. So I'm down $5 per share on this position right off the bat. But remember, I've still collected a premium, which helps to hedge a little bit of that loss. So now I'm in the shares. What do I do next? Well, this is why we call this strategy the wheel strategy, is because now that we're in the shares, we have new options in front of us, new ideas, new things that we can do with the shares. Now I can sell a covered call. Now I'm selling a call, but a covered call is when you actually own the underlying shares that you're selling a call on. Because think about this, if you're selling a call and the market just rips massively, you basically are selling someone else the right to buy calls, which means you would have to short the position. So if it went up massively, you'd be in a lot of hot water real quick. So instead, we own the shares. So if the market rips, we make money on the shares we own, but we also make money on the call we sold. And I'll show you again some more examples in just a second. So now I can sell a covered call as I own the shares and can write call options against my own shares. Let's just say in this example that we're writing a call 1 week away. So remember, we own the shares at $45 per share, right? So we have our position, and let's say we sell $50 strike price calls 1 week away. So in this case, let's say if the market goes up now in step number 7 and above my call strike price on expiration day, then I've completely reset, because the call option that other trader out there bought, they can now exercise their right to buy the shares at $50 per share, right? So they own shares at 50, I have them at 45, so I just basically get taken completely out of my position. My long position is what is called called away, because now I own the shares, I sold the calls, they offset each other, I'm out, and I make profit on both of those positions. And I'll show you again some examples in a moment. And at this point, we can start back at step number 1 if we want, and repeat the whole process. Now, if the market continues going lower, and we'll talk about this scenario, remember, this is why we sell puts and cover calls, and we do the wheel strategy on things that we actually don't mind owning for the long term. Because if the market continues going lower, I can continue to hold on to my position longer term and wait for the market to recover, and just sort of keep it in my portfolio in the meantime. Before we continue with some examples, I do want to just mention that if you are somebody who is interested in trading options and learning more about this, of course, I have some other free videos on my channel that might be helpful to you, but I also wanted to mention the brokerage that I use. I've used it for years. It is a remarkable US regulated broker. It's Webull, and there's a link down below in the description. If you do choose to use that referral link, you'll get sign up perks in the form of free shares when you sign up using my link, and full transparency, so will I. You'll be helping out my channel if you do choose to use it, but you don't have to. But there it is. That's the broker that I use in case you want to get started yourself. Okay, so now I figured we'd do a simple example, and this is actually one that I'm kind of in right now, and I'll show you that in a moment. But let's just say, going back to our GDX, which is the gold miners ETF, let's just say that I'd like to sell puts and start a wheel strategy on this. Let's actually break down how much money I could potentially make in this scenario. In fact, this is a trade that I'm doing myself right now. So let's just say that 1 month out, we wouldn't mind selling a put on GDX. So let's say, real quick, I'll show you the chart here. Here's GDX. It's trading around 26.36, and of course the price of the option in question is going to be $25 per share. So we've traded lower, we're looking a little overextended, and I wouldn't mind picking up some shares here of GDX. So I'm looking at GDX and I wouldn't mind picking up a position. So I look at the $25 strike price and I go 1 month away and I sell a put. Now, I actually sold 10 contracts personally. So the idea here is that I'm willing to buy 1,000 shares at basically the agreed upon strike price of $25. The premium was 49 cents. So 49 cents is what the options buyer, the person who bought those puts, paid. They paid 49 cents per share. So they total spent $490 in premium, and that premium went to me. So because I am the option seller, I sold this person this option. I collected a premium for doing so. So let's just go through this example. So again, by March 28th, if this market is trading above the strike price of $25, right? The strike price is $25. If it's above $25, then I make no money from the security because I don't own GDX. I'm just selling a put on GDX. I'm willing to buy the shares. I'm offering that insurance to someone else, but I still make $490. So if at the end of this period at expiration day, if it's trading above strike price, $25, I just make $490. But let's just say the price goes to $24. And at the end of the expiration day, obviously my put that I sold rocketed in value because of course the price dropped on GDX. If that happens, then if we're at $24 per share, I am down $1,000 on my position because again, the strike price of 25 is what I agreed. I still have to buy it at 25. So I am down $1 per share. I have 1,000 shares. I'm down $1,000 on the security. But I still collect the $490 in premium. No matter what, you always still collect your premium. If you sell the option, you collect the premium because you were the insurance seller, basically. So let's just say in this case, I am now assigned. So I have 1,000 shares. So I have 1,000 shares to my name now, and suddenly I have to figure out what I want to do with it. I'm sitting in somewhat of a drawdown because between the two of this, I'm about down $500. I collected premium, but my shares are worth less. And so again, I'm down about $510. After this period, let's just say I say, okay, well, now I'm going to go ahead and actually sell a covered call. Why covered? Because I own 1,000 shares. And let's just say I sell 1 month out, $26 calls, right? So $26 calls that expire in 30 days. If at the end of this period, let's say price moves up and we're above $26 per share, well, how much am I up on the actual security? Well, I have 1,000 shares. I'm up $1 per share. I'm up $1,000. And I still have my initial premium. I made $490 the first go around, and let's just say I made $500 on the second covered call option that I sold. Between the two, I make $990, right? Between the two options that I've sold, but I also made $1,000 in the shares actually going up in value. At the end of this period, I have made just about $2,000 overall, $1,990 between the options premium that I've collected and the share price appreciation. And this is not even including if during that period, GDX were to pay a dividend, which would be even more income for me during this time. You can see that the point of this strategy is to collect income, to collect yield from multi-directional kind of stuff, and to benefit from a market just going back and forth overall. Now I should add something. Let's say the market rips above $30, right? Let's just say, again, in this case, I own 1,000 shares. So you might be saying, well, you're going to make a lot of money in that scenario. Nope, I make the same amount because remember, I make $1,000 only because I am obligated to sell the shares at $26 because I sold that call. So I have to sell it at a max of $26, even if the price is at 35, right? Or 30. So just so you know, this is kind of the capped upside of selling options for premium within the wheel strategy. There is upside cap, which is of course something that is not obviously ideal, but I'm willing to accept capped upside for consistent yield from multi kind of approaches, whether that be from dividends, from the options premium, and from the P&L itself. So I mentioned I would show you one of my current examples, which is GDX. So GDX, I quite literally took this and made it into the presentation. This is a trade I am in right now. So I sold this put with about a 30-day out, kind of till expiration day. You can see I sold 10 of these puts, right? 10 options contracts. So in this scenario, you can see that I actually want the price of GDX to go up in that scenario because in that case, I just collect the premium and I walk away without any issue. And so here are some more examples of some of the things that I'm doing in my Webull account. So I've sold several puts here recently, and with the market overall moving higher, you can see I don't really have too many positions actually filled. In fact, most of my options are very much not getting assigned. And that is, of course, assigning is when, when the market drops below your strike price and you have to buy it and you're in the position and you start doing covered calls. So I have one position, FXI, where I had a scenario where I am now in the position and I'm selling covered calls. This is what it looks like in Webull. Webull is super convenient for this. It's very simple to use and follow along. So the other ones, XLY, IWM, this is the Russell 2000. This is the technology ETF. XLY is consumer discretionary. So these are companies, that I personally wouldn't mind owning in my portfolio for the longer term. GDX, as I showed you here in multiple sessions within the video here today. So I'm basically selling these things for, basically wouldn't mind owning these shares, but I'd like to see a price dip in order to get assigned. What I love about this trading strategy is that, first of all, it can do well in kind of range-bound markets, slightly down markets. It can do well in upward markets. It's just not as good as, of course, a market ripping higher, just owning shares. But for the most part, it typically does okay. It does pretty well at kind of smoothing out your returns overall. So if this is something you'd like to get more into, again, the broker that I personally use is linked down below in the description. It is Webull. So check it out, take advantage if you'd like to get those free shares using that link. And I hope this video was helpful to you. Have a great rest of your day. If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel. And we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.